Good afternoon to those of you that we have logged in already. We're going to give everybody just a few minutes to get online, and then we will start the program. So we're right at noon. We'll probably give everybody just 2 or 3 minutes and then get started. But thanks for joining us. All right, we are just a few minutes after 12 o'clock, and I want to be respectful of everyone's time. So we'll allow people just to continue to log in as we go, but want to go ahead and just get started with our program today. Good afternoon and welcome to our August webinar focused on affordable housing programs. It's hard to believe we only have 3 more sessions left in this series for 2021. For those of you who are new to our series, my name is Rita Blevins, Director of Professional Development for HAR, and I'm your official moderator for today's program. Our theme for this annual program is Opening More Doors in 2021. Each webinar, as you all know, is geared towards educating the realtor community about programs, solutions, and opportunities for clients in this ever-changing financial environment. So throughout the rest of the year, we hope to continue to provide the information that will provide or create more awareness, take away any stigmas associated with the idea of affordable housing, and just provide you guys with some great education to share with your clients. All these sessions will continue to take place on the 3rd Wednesday of the month from 12 to 1:30. And as you registered for this one, you can register for the rest of them at har.com/webinars. Today's program is going to be presented by Julia Koski, and the objective for today's program will be to help you all develop an understanding of how mortgage insurance can be used by a lender's partner as a tool to manage. Oh, that's not it. That's not what is that what you're talking about? Yes. Mortgage insurance can be used by it sounded like I worded that wrong. Mortgage insurance can be used by a lender partner as a tool to manage discrepancies between the purchase price and appraisal. But before I pass the virtual microphone off to the expert, Julia, I wanted to remind you to put your questions into the chat throughout the afternoon. You can choose for the questions to go to everyone or just panelists. I can see that everybody's starting to take advantage of the chat, so we appreciate that. We will field the questions throughout, and then again at the end as space permits or time permits. So if something is pressing, feel free to type it in, or if you want to wait till the end, there'll be opportunities there as well. And since I know you're going to all ask, this and all the upcoming webinars, as well as the past recorded webinars, were recorded. They're available on HAR TV. Our YouTube channel is located at har.com/HAR TV. You know, there's nothing better than seeing and hearing it live, so you can actually interact and speak with the speaker or the expert to ask your questions. But in case you missed something or want to go back and hear it or even share it with other folks, it will be housed on the HAR TV YouTube channel. So let's meet your specialist for today, Julia Koski. Koski is an account manager at Enact. With 5 years at Enact and over 30 years in the mortgage industry, she has experience in loan origination, sales, business development, operations, and training management in both correspondent and retail mortgage lending. Julia is the president-elect of the Minnesota Mortgage Association, or MMA, for 2022, and has served on the board for several years. She was awarded 2019's Industry Professional of the Year Award for the MMA. She holds a degree in biology and psychology, so you understand brains and both behavioral and like the makeup, right? From McAllister College, is currently working on your CMB designation with the Mortgage Banker Association. Thank you again for joining us today. I'm going to go ahead and pass the platform over to Julia, and I'll be back later to field the questions. Thanks so much.
Wonderful. Thank you so much, Rita. I really appreciate that. Can you confirm that you can hear me all right? Great. Great. That's wonderful. I'm going to share my screen now, everybody, and we're going to hope that this works, right? I'm going to go here, share. Now I'm going to start it. Here we go. And then I'm going to, all right. So yes, as we were saying, thank you so much for having me here today. When I learned about what you are doing with Freddie Mac and you're hosting these learnings and this educational period, I was just absolutely thrilled. And I was just in a meeting this morning with our Minneapolis Association of Realtor group, and I was telling them what I was going to do, and they're all like, really? God, I'd like to learn more about that. So I might circle back with this a little bit later. But we're going to talk today about leveraging mortgage insurance to get your customers to the closing table. And one of the words that came out earlier when we were talking about our introduction is stigma. And you talked about stigma for first-time home buyer or down payment assistance program. Mortgage insurance carries its own stigma as well. And we're going to talk a little bit about that as we move forward. So let's take things on. So we're going to talk real quick. We used to be Genworth Mortgage Insurance, and this is just an FYI for you guys. If you've ever, Enact is new. Enact has been around for about 2 months now, but Genworth Mortgage Insurance, which is simply now a new, as an Enact is now the new name, has been around about 40, 45 years or something like that. And so we just changed our name. So if you want to learn more about Enact, you sure can. And there's a link associated with that. But I'm bringing up the links for a couple of reasons. Someone had texted in the chat feature, are there handouts? And there's really no handouts for this, but the presentation will be available for you and it can be sent out to you. And the presentation will have a lot of links that will allow you to click on and get some further information on things. So if you're not interested in Enact, but you sure might be interested in something like a Freddie Mac program for some housing expansion and that kind of thing. So let's move along with MI though. First thing we're going to talk about is what is mortgage insurance. And I know it's starting with MI, I get it. It's not the most dynamic topic, but one of the things that I wanted to touch base with is private mortgage insurance, or MI, or you might hear it referred to as PMI, provides credit enhancement with mortgages, conventional mortgages, when loan to value is greater than 80%. So let's unpack that for a second. Credit enhancement, think managing risk when you're talking about credit enhancement. It helps lenders manage their risk. And when we're talking about conventional mortgages, we're simply talking about mortgages that are originated and closed under the guidelines of Fannie Mae and Freddie Mac. So you've got those, or the GSE. So you might hear me say GSE, you'll probably hear me say Freddie Mac and Fannie Mae, but they're the same thing. They're not the same companies, but they're both GSEs, or government sponsored entities. And you might hear me actually say agencies, because they're often referred to as that as well. But when their loan to value is greater than 80%. And again, remember that loan to value is simply the loan amount that has been decided upon divided by the lesser of the purchase price or appraised value. And that's how we get our loan to value. And so it benefits lenders, investors, and borrowers, but it benefits them differently. And we'll talk more about that. And it is required on conventional loans when that LTV is greater than 80%. This is not something the MI companies came up with. This is based on guidelines that are put forth by Freddie Mac and Fannie Mae. We, as private mortgage insurance companies, there are 6 of us in the country. Enact is one of them. We've been around a long, long time, as I've mentioned that. and we're regulated at the state level by the Department of Insurance. So as you heard before, I'm from the cold, and though it's extremely hot today, state of Minnesota. And so our state regulatory body, the insurance body, may be very different for how I am licensed than, say, the great state of Texas. So we have to follow those considerations. And we are also subject to requirements by the GSEs. And when I say requirements, we as the mortgage insurance companies, all of us work cohesively and collectively with the agencies, Freddie Mac and Fannie Mae, to work on requirements and work on programs that are going to be beneficial to borrowers. Because if they come up with a great program, we have to be able to insure it. So we have to work together with them when we do on a very high level. So let's talk about what mortgage insurance does. It insures the lender, not the borrower, in case of that default on a conventional loan. So if the borrower defaults and the lender submits a claim, the lender is compensated for that. The borrower is not. The investors or lenders determine the type of mortgage insurance they allow, and that's generally, it's about a product. And we have different types of mortgage insurance products. Monthly, which is what you're probably, and your borrowers or your clients are going to be most familiar with. And that's simply the MI payment is part of their principal, interest, taxes, and insurance, their monthly mortgage payment. A single premium is one that is simply paid upfront. It's a lump sum, one and done. You might hear it paid, talked about as a single pay, one-time MI. They're all the same, but it's basically paid upfront at closing. And then we have a split premium. And a split is, how do you want to put it? It tends to be something that comes into favor in different markets and in different parts of the United States. And it's simply a hybrid of a monthly and a single, where your borrower or your client, depending on who we're talking to, but your borrower is going to put money up front, pay a portion up front, and then their monthly payment is going to be reduced. Splits are really popular in the greater Northwest part of the United States, and they tend to become more popular when it becomes more of a buyer's market, and you'll see things like seller concessions. That's not what we're seeing right now, that's for sure. But what MI is not is life insurance or credit life insurance for your borrower. It is, again, it insures the lender. Life or credit insurance, those are different products. And you might hear something about mortgage insurance from a typical life insurance agent. But again, it's a different product and it's priced and paid for differently. It's not part of your mortgage payment. FHA and VA loans are insured by HUD and the Veterans Administration, and they have specific types of insurance as well. FHA has mortgage insurance premium, often referred to as MIP, and VA has the VA guarantee. How does MI help the borrower? The borrower's bottom line is they can put less money down. That is absolutely it. You can purchase a home sooner if you're utilizing mortgage insurance. Your average homeowner can take up to 10 years to get that 20% down. Even if you have a $200,000 loan or $200,000 purchase price, that's $40,000 if you need to save up for 20% down. And so it can take a long time. And so mortgage insurance simply allows that borrower to get into a home faster. MI can be canceled as well. And we're going to go through that in a lot of detail, because a lot of times when you're working with borrowers, we talk about stigmas because mortgage insurance can be thought of as a necessary evil. And I hate to say that because I sell the product and I absolutely think it allows for some wonderful opportunities for homeowners. But if they don't understand it, you have to, you've got to spend some time to explain it to them. But it can be canceled, and it can be canceled faster depending on your borrower's time frame. It can be canceled by the lender as well. And it's often more affordable than FHA loans. FHA does require an upfront PMI payment, if you will, and then monthly payments throughout the life of the loan, whereas a conventional mortgage insurance program is not for the life of the loan. And then, of course, there's some tax deductibility. And I'm not going to go into that at all. All I'm going to say is it generally tends to be based on your tax bracket and to check in with a tax professional for sure. Common MI questions that come up a lot, and so we'll answer them. Do you always need MI when you have less than a 20% down payment? Not at all. Many lenders have programs that require 10% down that don't have mortgage insurance or 5% down or 3% down. You'll find them all over the place. But one thing you need to remember is that I mentioned it was my very first slide where mortgage insurance is part of credit enhancement or managing risk. So if you have less than 20% down and you don't have mortgage insurance, your lender or your investor is putting together a program and managing risk differently. They're using another tool, and that could be pricing it differently or something else. Am I pay off a loan that's in default? If my borrower or my customer is 180 days out, no, they don't. It's not a default product. The property actually has to be out of foreclosure and sold before a lender can submit a mortgage insurance claim and have it processed. So that can be a very long process. I don't know about Texas at all, but I can tell you that in the extremely slow state of Minnesota, it can take a couple of years to get a home from default and the whole process going. And it can be extremely expensive, as you can imagine, for that lender. And that takes me to my last question, which is, do lenders make money if they sell the property for more than what the borrowers owe and then they collect an MI claim? And that is not true either. The amount of the claim that a lender is going to submit to an MI company is based on the post foreclosure sale amount. How much are they selling that home at the time of foreclosure? And then they take that dollar amount and then they calculate how much did it cost them in expenses. Going through the foreclosure process is extremely expensive, and the longer it takes, the more it costs. You've got legal fees. You're managing that property. Do you have to update that property? Do you have to clean it up? Do you have to manage the yard? All that kind of stuff comes into play. And so those costs associated with managing get added in to the loan balance. And then if there's a difference, mortgage insurance comes into play. And that's where the claim comes in. The idea is to make the lender what I call whole. So they're not losing an excess of money in the transaction. Okay. So talk about stigmas. Why do borrowers dislike MI? And they do. I have an extremely good friend who is a realtor, and she was talking to me yesterday at an event, and she was talking about her son, how I wanted to get rid of that stinking MI. And I had to laugh, and I said, do you know what I sell? And she said, oh my gosh, you do. And so I went through the whole process of canceling MI with her, which we'll go through. But again, it was a comment that she made. It was stinking MI. Why do they dislike it? Because it's personal. It is absolutely personal to them. If you remember my very first line about what MI does, it insures the lender in the case of borrower default. So number one, if you tell your borrower that, or if a lender tells your borrower that, your borrower's going, wait a minute, I've paid my bills on time perfectly. I have a very high credit score. I might have a 780 credit score, which is extremely high. And it shows a wonderful credit awareness and discipline. But if you don't have that 20% down, MI is part of the equation. But they feel that it's personal because it doesn't help them at all. And that's where we need to make sure that we go back and make sure they understand that mortgage insurance comes into play when your down payment is more limited. So you don't want to be said that you're a credit risk, because they don't think you're going to pay your bills because you might go into default and your lender can make a claim. It's just sometimes hard for them to get their minds around, and it becomes very personal. Because remember, buying a home, besides being incredibly emotional experience, is extremely personal. You're talking about their income, you're talking about changing their lives. So what do you think? The first question that the borrower asks when they're told that they need mortgage insurance on their loan. And you don't have to write this down or put in the chat feature, but I will tell you what it is. It's what you might think it would be. How long do I have to have it? And we'll cover that, because the answer, and I would ask you to maybe do that on the chat feature when we get there, is that you can tell me how long you think they need to have it. But in the meantime, let's talk a little bit about our landscape today. Our mortgage origination landscape, what's happening today, and then some possible solutions that can help your borrowers move forward into that closing that we all want them to be, because we're all working for the same thing, which is to get that borrower to the closing table and have them be happy that they bought that home and feel good about being part of that community. So what's the housing market like in your area? if it's anything like Minnesota, which I know we're talking totally opposite end of the country, north and south, et cetera. But what we're seeing is it's pretty busy right now. And just to quote a survey that was done in realtor.com, is actually done back in March and April, that if people were seriously thinking of putting their properties up for sale, they're all expecting to sell at a profit, as you can imagine. And you know that the median home price has gone up. We're talking about $375 in April. And the homes are selling quite a bit faster. It says 41%. It might slow down a little bit now. I know it is in my market. It has slowed down a little bit in some price points. Perhaps that's the same way as yours, but we're still seeing homes move pretty darn quickly. I like the last bullet. We've talked about a quarter of the sellers expect us to have an offer within a week of them putting their home in the market. And then 16% anticipate receiving an all cash offer. And that's also what you guys are looking at. You're looking at your borrower who's going to be trying to compete against a cash offer. So let's see what we can do to help on that. So what's happening in our markets? We still have low interest rates. Who knows what's going to happen? That conversation was happening this morning that they think interest rates are going to be raised by the end of the year, but they're still really low. I mentioned, or it was mentioned, that I have been in this market like 30 years, and I suspect some people on this call that remember double-digit interest rates, because that's how I got into this game. I came in by doing refinances from, say, 12% down to 8%, and everyone thought that I was the greatest thing since sliced bread. But can you imagine? That was a way different time. But interest rates are historically low, and money is relatively cheap. And there's inventory shortages at certain price points. Absolutely. In my particular market, anything under 350 goes like you would not believe. It's barely out, and half the time it's not even really listed. It's kind of all done behind the scenes. As we get up a little bit higher, there seems to be more out there that sticks around, that has some ability to be perhaps some negotiation, but not a whole lot. So, and then we've got one thing, which is appraisals that aren't appraisals that aren't necessarily matching purchase prices. And we've seen this before, but we're going to talk about how the change is now. But what does this mean for our clients, your lender partners, borrowers? What does it mean for them? They're concerned that they won't find a home. They've been working with you for 3, 4, 5, 6 months, whatever it has been, and they've been bidding on homes and they haven't gotten them. It's really a frustrating experience. I can't even imagine the highs and lows that they go through. They're all excited, and then yet another home that they don't get. And so there's a big concern with that. And I'm seeing in my particular market that some folks are taking a hiatus, especially now that kids are starting school. They're kind of just backpedaling and saying, you know what, we're going to take a break, man. And I don't blame them. They're also concerned that they may have overpaid. Now that they've got their home, did I pay the right amount? Is it too much? Did I just kind of settle? And so we want to, deal with those concerns as well. And then lastly, they're concerned that they won't really be able to afford their home. And so they want to make sure that when we're looking at that, does it actually work for them to be in this home? So let's talk about our client's frame of reference. When I say, where did they start their journey? And my point with that particular bullet is, how did they work with you? Were they referred to you by a friend, or did they find you from a house listing? They went to realtor.com or other sites. Regardless, or did they go to a lender and say, you know what, my friend went to you and I need to talk to someone about getting pre-approved. Regardless, the point that they want to do is they want to figure out how much they can afford, how much home they can afford, and how big a payment they can have. And so they're going to seek out that lender partner. If it's going to be from you or someone else they know, they've seeked out somebody to get that pre-qual, or better yet, that pre-approval, and get to that comfort level on what they can afford. So in my example here, I have an original offer and some financing structure just set. This is what we normally want to see. In this case, you get a sale price of $219,900. I've got a loan amount of $169,900, and I get a nice down payment of $50,000. That's a lot. And I know we're talking about maybe some affordable housing options, $50,000 is a lot, and we probably wouldn't. It might not be the best example, but my point is this has to do a little bit with MI, so bear with me on that. So what I've got here is a 77% loan to value. My sales price is 219. My loan amount is 169.9. And that's, I've talked to a lender. I'm comfortable with the loan amount about 170. I've got a nice down payment. I've got 3% wiggle room, if you will, that I can maybe bid up that sale price a little bit and still not have to deal with that MI. But now we got our contract. So what's happening? So this is what happens. We have our original offer. I just went through that with you. This is what they're looking at doing. And then this is what happens. You got a list price of 219, but everyone got so caught up in this and everyone's feeling comfortable. They got an offer accepted at 250. So all of a sudden, the second bullet that I mentioned is, what are the concerns of the borrowers? They accepted, I maybe pay too much. And then we've got the third bullet, which is the appraised value came in at 224. Came in more than the purchase or the original list, but it came in less than that appraised value, or excuse me, that offer. So we got a shortfall of $26,000. Now what are we going to do? And so we know that appraisals come in low all the time. And all the time, you know, it could kind of go in fits and starts. All of a sudden I'll see a half dozen in 2 months, and then I won't see any for the next 6 months. But we're seeing it a little bit more now. And so that appraisal number is coming in and we're like, yeah, it's not quite matching that sales price. So now we have to look at doing something different, don't we? And so what we've got is the financing structure if you want to get rid of MI and then maybe use some MI. So my two examples here, I've got a sale price at 250 and I've got my appraised value at 224. If I want to stick with my I don't want mortgage insurance mantra here, I'm going to have a loan amount of 179.2 with a down payment of $70,800. So I'm going to need an additional $20,800 to do what I originally thought I was going to do. Plus, I've got a loan amount about a little under $20,000. No, about $10,000 more than I anticipated, which is frustrating. Or in my second scenario, which we're going to take a little bit further, I can just use my $50,000 that I have for my down payment and just do a loan amount of $200,000. That's going to give me an 89% loan to value. It's going to require MI, but what it's not going to require me is to have an additional $20,800. And for some customers and borrowers are going to say, well, that certainly helps because I don't have any resources to get another $20,800. So in my little example here that I have on your screen, I've got first mortgage P&I of $954, and that's simply based on a $200,000 loan amount at 4% at 30-year fixed. And I know 4% is high right now, but that's my example. 4% interest, 30-year fixed rate, got taxes of $4,000 a year, so I've got $333 a month, and I've got $65 a month in homeowners insurance. Those are just numbers that I came up with. And then I've got mortgage insurance of $80 a month. And that's going to be based on my loan to value for monthly mortgage insurance. And I picked a credit score of 700. 700 is a solid score, but it's not a great score. There's a real difference, just like with pricing anything else. You price mortgage insurance based on many factors, and credit score is one of them. And so it's a good score, but someone who has, say, a 780 score is going to have a little bit different price on that. So the next piece is now we've kind of got that borrower comfortable saying, okay, well, I can still use my $50,000 now, and I'm going to up my mortgage amount, but all of a sudden I'm upping my mortgage amount from $169,900 or $170,000 to $200,000. I've got $30,000 here. So what else can be going on? And the point is, with increased loan amounts, you have increased DTA or debt to income, and that's just another component on how your lender partner is going to qualify that borrower for that loan. So in our case, we've got our principal and interest, taxes and insurance of $1,432. And in my example here, I have credit card payments of $350, car loan of $457. So that's giving me a total fixed monthly obligation of $2,239. And I've got my gross monthly income, which is very stable. And we verified all that stuff because that's what we do. And that's a $43.90. And that's going to give me a DTI, which is my expenses divided by my income at 51%. Is that going to qualify that borrower? It might not. Generally speaking, if you're going to submit a loan to Freddie Mac or Fannie Mae, we're really looking at trying to keep that DTI under 50. And sometimes that's even 45. 51 could work, but we're going to be looking for compensating factors. And those are generally other sources of cash. But it could work, but it might not work. So let's try to get it in such a way that when that loan is run through the automated underwriting system, like our partner Freddie Mac's loan product advisor, that we're more likely to get that approval that we're seeking. So let's see what we can do. Let's say that we're not comfortable with that 51% DTI. And so we're not going to use that example that I have in the upper left-hand corner. Let's say, okay, now what can we do? We could do something different. Let's take that mortgage insurance totally out of that payment. So I bring my payment down to $1,352. How am I going to do that? And I'm going to change my mortgage insurance to a single premium from a monthly premium. So that's going to be upfront. You see in the star in the lower right-hand corner, that's $3,300 based on those parameters. It's one and done, $3,300. The borrower doesn't have to think about mortgage insurance again. And that works. There's great ways to pay for mortgage insurance for a single premium. It can be paid for by the borrower's funds. Perhaps they have additional funds for what they're going to need to pay for their closing costs. It can be paid for by a gift, perhaps. It could be paid for by seller concessions. Probably not in this market. I get that, but it can be paid for by seller concessions. And what we're seeing mostly for this situation is when you have what we call a lender credit, where the lender works with the borrower to absorb that cost into doing that transaction. So in this case, if we take that $80 monthly fee out of the transaction and just pay it up front, you get a debt to income of 49.17. You've got a much more likely approval rate of approval than you do at 51% if you're running it through an automated underwriting system. So we've got that opportunity. So you got a single premium. So you've got monthly, which might not work, but you can always look at doing a single. But what if, I don't have a gift. The lender can't do a lender credit. I'm not going to get a seller concession. I don't have the cash. That's fine. We can look at doing something else. We can look at doing a single premium, but we can finance it. And this is probably one of the best kept secrets, if you will, that people tend to forget. Financing that mortgage insurance into the loan amount. So let's take a look at how that works. Remember, our single premium was $3,300 up front. And so what we're simply going to do is increase that loan amount $3,300. So you're going to finance $203,300. So what that's going to do is that's going to up our payment, our P&I, principal and interest, by about 15, 16 bucks a month. And so that's going to take our DTI just a little bit higher. It's still going to keep it under 50, which is what we're looking at doing. And I want to draw your attention real quick to the little grid that's right under the title or the word premium. And that is simply a mortgage payment calculator. So you take your rate, whatever your interest rate is, in our case, that was 4%. And then you'll see where it says 10, 15 to 30-year terms. And that's your term. And you kind of do the old, put your fingers together and you come up with a factor of 4.77. So it's $4.77 for every $1,000 that's going to be financed. So that's how you calculate it. And so the money is relatively cheap because look at the difference between 3% interest rate and a 4% interest rate. It's about, I'm checking here, it's about 55 cents per thousand per month. So it's not a ton. Money is cheap right now. So financing what you can is really generally a pretty good idea, at least in my opinion. So let's say we can do that. So that works really well. So before we talk about getting rid of things, just kind of to back up, if you've got a situation where that appraisal does not match that purchase price, and perhaps we've had some bidding wars, so it's moved up, and we have to change that, we can actually use MI so that they don't have to, your client, the borrower, does not have to bring more funds as a down payment. So we can use MI for that. Kind of a gap, if you will, gap coverage. You might have heard that phrase. It's not a new product. It's just how MI works. And then you have to deal with the fact that if you've got a higher loan amount, we have to manage that debt to income. And so there's different ways of using mortgage insurance to help with that as well. So Now that we've got that piece, so we've got that particular piece done and our borrowers, okay, we're comfortable with this. But you know what? The first question that they ask you or your lender is, how long do I have to have MI? So if I can, and this, I know I didn't talk to Teresa about this, but I'm hoping that if someone could just throw open chat and say, how long do you think you have to have MI? If someone just throw a number into the chat feature, and if Teresa, if you could give me a couple of answers, I'd appreciate it. And if you can't, that's okay too.
Someone said life of the loan. Another person said 5 years.
Perfect. Okay.
Until the loan balance is about 79% or until you get 80%.
Wonderful. Thank you so much. I really appreciate that. Okay. So one is close. The 80% can be close and the 79% is close. And MI generally does not have to be on the loan for the life of the loan. When I say generally, there are certain products it does, and we'll touch on those. And so that's really interesting. So let's talk about canceling MI. And my customers, when I say my customers, which are your lender partners, they always get a chuckle about, gee, Julia, you seem to be so quick to tell us how to get rid of you. And why that is not necessarily my intent, but I want to make sure that borrowers have a comfort level, and you as realtors have a comfort level, and your lenders have a comfort level to understand how mortgage insurance cancellation works. So, okay. A couple of things with regard to Homeowners Protection Act, and that's where that 79% answer, I believe, came in. But there's an automatic termination with mortgage insurance as it relates to conventional conforming loans. So Homeowners Protection Act of 1998 basically says private mortgage insurance has to come off your loan once that loan amount amortizes down to get to an LTV of 78%. So that could be during the normal course of an amortization term. It could be sped up by some additional principal payments, but once it hits 78, the servicer, the mortgage servicer, that's who your borrower or you and me are paying our loan payments to, they will connect with the MI company and say, hey, the Koski loan, done. They're at 78%, and you will see that come right out of your payment. You will not see that monthly mortgage insurance payments on your payment anymore. So that's automatic termination. And that covers single family owner occupied primary residences. And that's really what we're going to talk about the most of, because that's usually who our borrowers are. Single family owner occupied primary. And also in this case, this is going to cover single family owner occupied second homes as well. 1 unit second homes. And that's because Freddie Mac and Fannie Mae have chosen to to add second homes to those guidelines as well. But there's a different way to look at cancellation. You'll notice in my graphic here, we're trying to make this as easy as we can. We have something called automatic termination, which I just described to you, which is that 78%. When that loan balance gets down to an LTV of 78% on your single family owner occupied, MI is gone. It's got to be canceled. But there's ways that the borrower can cancel it and work that process a little bit faster. So there's 2 scenarios here, and they're both based on the value of the property and what value we're using. The first way to get rid of MI quicker is to look at the original value, and that's in the, I would call that a kind of a wine color circle with the letter O in it, meaning original value. So that means if once that borrower has paid down that loan to 80% loan to value, they can contact the servicer again, who's collecting payments, and say, hey, my loan to value is at 80%. I want to cancel MI. How do we have to do that? And then your servicer takes them through that process. They say, well, we need it in writing, whatever their requirements are. And they take a look at it. And then they say, yep, it's done. And then they will contact the MI company. It doesn't matter what MI company is, the rules are all the same. So it's the same as the NACT and any of my 5 other competitors. And they say, yep, mortgage insurance is gone. The other way to get rid of mortgage insurance is when you want to look at today's value or current value, which is where the green circle, kind of an olive green with a C in it, that means current value. Think about it this way. I bought my house in 2017. I paid X for it. And all of a sudden you notice that, or no, let's just say I just bought my house just down, this year. And I noticed that the very similar house down the street just sold for $30,000 more. And you're like, yeah, that's great. You know what? I can get rid of that MI. Yeah, you can, but there's a bit of a rub there. If you want to use today's value, meaning I want to get an appraisal and see how my value has increased, I have to wait for 2 years. And that is a rule. So you have to have 2-year seasoning, and that just means MI's got to be on that loan for 2 years minimum. And then for the first 2 to 5 years, your loan to value's got to get down to 75%, not 80, 75. And that again is a rule. So your borrower's got to be really confident that that value has increased quite a bit if after 2 years they think they're going to be at 75% loan to value. And they very well may be. With the market the way it is today, who knows? But again, that's where 2 years comes into play. The other one, which is in the middle of the screen where it says LTV less than or equal to 80%, there is no seasoning requirement for that. So think about that. Your borrower could actually have mortgage insurance for less than a year if that loan to value comes down to 80% in various ways, which we'll cover in just a little bit. They can connect with that servicer and cancel that MI and have that requested. So mortgage insurance does give some of the power back to the borrower so that they can try to manage that and get that loan to a certain LTV that will allow them to cancel that MI. Because it's all about skin in the game. Yes, go ahead.
We had a question, and we did have a question from earlier, but we'll kind of come back to that one. But Claudia,
sure.
I'm sorry if I pronounced that wrong. Claude wanted to know, would MI companies require an actual appraisal or use AMVs and or local appraisal districts appraised values?
That is an excellent question, Claude. And you're not going to like my answer because it's going to be, it depends. And it depends on what the servicer requirements are as they're working with an investor. Because remember, a servicer collects payments in, and then they go and they talk about, and then they collect payments on behalf of somebody else, generally. So it could be, let's say, Wells Fargo or US Bank, and you might be making payments to Wells Fargo, but it could be a different servicer that you're making payments to something else, or you're working, the loan has been sold directly to Freddie Mac or Fannie Mae, and they have a designated servicer. So they're following their rules. But give me 1 second and I'll tell you that answer in just like 2 slides, okay? So, but it is going to depend on the market. So finishing up with getting rid of MI, this last slide here, which talks about properties that are not covered under HPA, which is 2 to 4 primary residence and 1 to 4 unit investment properties. You can see where getting rid of MI is going to require that loan to value to be considerably more. It's got to be 70% LTV. And then in one case, our friends at Freddie Mac say 65% LTV. So again, think about it as skin in the game. The more money the borrower has of their personal money in, the shorter they need to have mortgage insurance on that property, because that's their money. If I'm using the newest value, the today's value, that's not money that I put into that transaction. That is simply the market appreciating. And so that's where that 2-year rule comes into place. So now I'm going to answer your question, Claude, right here on this slide. All right. So other cancellation considerations. You're going to see this last bullet. I'll come back to the top ones, but the last bullet on the left there, it says evidence of home value confirmed through GSE's collateral tools. So there's going to be opportunities for that value to be confirmed based on the collateral tools used by Freddie Mac and Fannie Mae. So it doesn't necessarily require a brand new appraisal. If you are looking though at a it depends on the market, and it depends on how well the collateral tool works in certain areas. Perhaps it's a rural market, that kind of thing. You may need a new appraisal. And you or your borrower would have to adhere to the rules based on what the servicer is going to tell them. And so it generally would not be an appraisal that is ordered directly by the borrower. It's going to probably be directed by the servicer to say, you know what, we'll contact XYZ appraisal company because they're a management company that's approved by the investor, and they'll go from there. So most of the time, you're going to try to get that evidence of that home value confirmed through the collateral tools, which would be the best way because that's going to be the least expensive. Otherwise, the borrower would be on the hook for a new appraisal, in fact, if they wanted to have today's value. Does that make sense? I hope so. Let me know if it does not. But to come back on that, I answered the question about how do you get your value. You've got to be current on their payments. I have this conversation, and I know my counterpart Tara does as well, probably once, maybe twice a week about canceling mortgage insurance, because I talk to lenders about it, and then all of a sudden a customer comes in and they want to be sure, so they call me. And you got to be current on the payments. You do. You can't have late payments. I don't know why that doesn't seem obvious, but you can't. And so you can't have no late mortgage payments in the prior 12 months and no more than late payment more than 60 days late in the last 2 years. So you even get some wiggle room, but don't have late payments. There can't be any second liens on the home. So if there's a closed-end second, a second mortgage, or a home equity line of credit, often referred to as a HELOC, can't have it on the home. It's got to be gone in order to cancel MI. Cancellation request needs to be in writing or whatever your servicer requires you to do. So you may need to write a letter, or you may most likely an email would suffice, but you have to follow their dictates. And again, that evidence of the home value needs to be confirmed through the collateral tools. And so it can be done, but there are going to be some steps that are going to be required by the borrower or your client. They can't call the MI company and say they want to cancel MI. We would simply direct them back to the servicer. They can't call you. They can't call their lender. We again would have to direct them to the servicer. So anything that's under borrower initiated cancellation has got to be done by your borrower. Okay. So you can cancel faster by paying ahead on that mortgage. And we say pay ahead, making principal reductions. We see this all the time where you've got a situation where perhaps a borrower hasn't sold their first home yet, and they're looking for, they were going to use that equity, but they can qualify for that second home without worrying about the equity position. And then they finally sell the house, they make a principal reduction, and they cancel MI. It can be done. It happens all the time. So they can pay ahead on that mortgage and get it down to 80% faster than the amortization period. That's fine. Both Freddie Mac and Fannie Mae do not have seasoning requirements on that. They do, remember, if they want to use the current value or the newer value to realize some appreciation. But if we're using that original value, there is no seasoning requirement. Making substantial improvements to the home. This is the one caveat to the 2-year rule for getting rid of MI based on the appraised value. If you have a situation, let's say, that your borrower bought in a neighborhood that perhaps they got the cheapest house, the only house that hasn't been updated. We all have those neighborhoods in our communities where, things have gotten a little run down, but many people have bought into them and then done substantial improvements. And so, the values have gone up. And now this person has come in, they get the last one, and they do substantial improvements. And let's say they put in $100,000, they put in a new kitchen and a new bath, etc. They've checked out that property. At that point in time, there can be the option of canceling mortgage insurance. Our friends at Freddie Mac were kind enough to put in their guidelines what they consider substantial improvements. It's very nice. It tells you kind of what they're looking for here. Substantial improvements are not a new roof. That is maintenance. Substantial improvements are things like a new room, an updated bathroom, a new kitchen, those kind of things where you're adding to that value that way. So keep that in mind. So there are opportunities to use the appraised value faster than that 2-year window, but it really is talking about substantial improvements. And then you want to check on your property value to see if it's increased. If that's been happening, make sure you're monitoring how long you've been in that house, and you hit that 2-year window, perhaps we can get that appraisal, get rid of that MI. And then there's always the old refinance option. You can always refinance throughout that period. If you think that values have gone up, you can refinance. Now, there are costs associated with refinancing. So your lender partner would work with that borrower to weigh the pros and cons of refinancing versus hanging out for another year or so to be able to just get an appraisal. So there's all sorts of things that can go on, but again, I think the main thing as a realtor working with your borrowers, and they're wound up about having to have mortgage insurance, if you could talk about the idea of it being cancelable, and feel free to refer them back to the lender partner. Talk to your lender about the opportunities that you'll have with canceling MI and how that works. Because honestly, they're happy to talk to you about it. We as MI reps are happy to provide information. These snips are simply from a flyer that we have as an MI company, that so that we could share that with our lenders, that they can share with their borrowers. But again, confirming that value, you see right here, Claude, current value got to be greater than or equal to the original value, and it's got to be compliant with Fannie guidelines. If you're looking at a loan that's underwritten to Fannie Mae, that's the original value, and then your servicer must verify the current value using the validation method acceptable to GSE guidelines. So could be an appraisal, could be their collateral tools. Hopefully it is a collateral tool. And Freddie Mac is basically asking the servicer to warrant that the original value supports the LTV ratio required to cancel. So the servicer might have some steps that they follow to verify that as well. So we've talked a little bit about, again, helping structure that loan transaction when things change and the borrower perhaps spends more money than they thought they were going to. We've talked about how we can manage that debt to income. And we've also talked about how MI can be canceled so that the borrower feels that they have some more control over that situation. So I'm just going to touch on a couple of other things that MI can help with regard to, getting borrowers to the closing table. And we're talking a little bit about the inventory problem. And we have that in our price point as well. And yeah, I know lumber prices were a big deal for a while. Now they've come down, but there's something else going on. And there's simply just construction shortages. There's people shortages. Homes aren't getting built that quickly. It takes a long time in Minnesota to build a home. There's a lot going on. The foundation, you got to dig a foundation because we don't build a lot on slab and grade up here just because of the freeze and refreeze market, that kind of thing. And it just takes a while. And so what we're trying to kind of talk to people about and get people more aware of is opportunities for improvements, like Freddie Mac's Choice Renovation Mortgage. I love this program. And the reason that's why I'm bringing it up, because according to the Harvard Joint Center for Housing Studies, almost 80% of our nation's 137 million homes are at least 20 years old and 40% are at least 50 years old. We all have those pockets in our community. We all have them just down the road from us where we've got some older homes. But programs like Choice Renovation Mortgages allow your borrower to get into a home and do those improvements and wrap it up into one transaction. And there's opportunities for them, to wrap in things like costs where they have to stay if they're in the process of renovating that loan. And so I ask you, or I hope that this provides you with maybe, that's something that we could do. Maybe you've got some customers or clients that might think, I want to stay in this area, but gosh, I don't know if I can really afford all this stuff. So let's, maybe we can get in and do some improvements and work it that way. And so I've got links you'll see here in the lower left-hand corner. Those are those links I was talking about. So when you get this actual hard copy or just, in an email, you'll be able to click on those links and it'll take you right to the Freddie Mac site to talk about Choice Renovation. Wonderful program. Yeah.
Julie, Rosary asked, FHA loans on PMI can't be canceled. Is that correct?
That is absolutely true. FHA loans, PMI cannot be canceled. It is for the life of the loan. You have that upfront cost and then it is paid. It's for the life until you either sell the house or refinance or pay it off. Correct.
And I did want to mention that last month's webinar, we actually covered, we had a guest speaker that spoke to the Choice Renovation Mortgage program. So along with your links, and if they go to the HAR TV channel, they'll be able to click on July's webinar and see what that program that Freddie Mac offers is all about.
How wonderful, because this is my only slide on this. So I'm not going any further than that, but I'm so glad because I really like this program a lot. But yes, do remember there is a difference. I'm going back to mortgage insurance real quick. Mortgage insurance 101. FHA mortgage insurance, also referred to as mortgage insurance premium, is a very different product from mortgage insurance or private mortgage insurance, which is associated with conventional loans that are originated to Freddie Mac and Fannie Mae guidelines. And FHA mortgage insurance premium cannot be canceled off your payment through the life of the loan. So you get to 50% loan to value, you still will have MIP on that loan. If your lender is any good, they will be contacting that borrower well before that they're paying it down that long. I mean, there's no reason why you wouldn't want to refinance out of that. FHA is a great program, don't get me wrong, but the way MIP mortgage insurance is structured with them, that's how it has to work in order to be able to work with that market and provide those opportunities with minimal down payments. So I want to wrap up though. I'm just checking my time and we're doing okay. With best practices. And you're going, Julie, what does this have to do with mortgage insurance? Well, it has to do with how we communicate as lenders and realtors and our clients / borrowers. And the communication is so critical on this. You guys get that? And you're like, yeah, duh, I get that. But it's so critical. And I just want to touch base on a couple of things and give you a few facts. I want you to think about how you and your client want to communicate with your lender partner. Is it better to call? Is it texting? Is it emailing? Because we want to make sure that even though we've gotten this borrower pre-approved for this loan, that doesn't mean that everything's a done deal. We still have to finish up that transaction. And there might be things that we need to get from that borrower. And remember, please, that there are things that your lender partner can't disclose to you as a realtor. You can't ask them for that and say, I can't give it to you. It's not because they're being jerks. It's because that's a privacy issue. So sometimes we're going to have to go through the borrower who can get it from the lender to get it to you, because a borrower can disclose that to you. They can disclose all they want, but a lender may have, there might be a hard stop and some limitations on that. But do remind your clients that there may be follow-up items. They're all excited. They got pre-approved. They were super excited. They got the house. They worked out through their kinks. They know MI is going to be there. They're okay with that. They're going to cancel it. And now I'm thinking about how I'm going to paint this place and maybe some new furniture. But there's probably going to be some follow-up stuff that we need to make sure that we're continuing on that process to get them to that closing table. And we're not getting them to that closing table in a horrible rush that everyone's stressed out. So how do we want to make sure that they get back to you as well as your lender partner? And remember, this is just really key throughout the whole process, that they want to be validated with their choices. Remember their concerns that they wouldn't find a home. Now that they found a home, did I overpay? And can I really afford this home? So we want to make sure that we're continuing on with that and reassuring them through this process. So just a quick thing. I liked this slide, and it talks about how we update our borrowers, your clients, on their loan. You'll see that this is from, I'm looking over, it's a net promoter score, and it's taken from the mortgage borrower satisfaction program. It's these braces. Sometimes I struggle with them. 88% of the folks love a phone call from the lender, but yet lenders only call 15% of the time. What we see 66% of the time is an email from lenders, and people are okay with that. But people do like phone calls. They really do. They like to hear from people. And part of that is they stand out because we get atypical business person gets 115 emails daily, according to the Radicati group. And that's a lot of emails that you're trying to sift through. But though, with a phone call, 80% of phone calls go to voicemail and 90% of first-time voicemails are never returned. I'm guilty of that as well. So what I'm saying on this, let's take some time. Make sure if you recommend a lender partner to your borrower, your client, let's get that lender partner's name in their contacts right away, so they know when Julia Koski calls them, that's my lender, I better get that, or at least double check what they have to say. So make sure that happens. I know that seems kind of like, of course I do that, but you know what? They may not do that. Your borrower may not think of that. So let's get that in their phone right away. They can delete it when the transaction's over, but let's get it in there now. The other thing we want to think about is, at least with my lovely iPhone, it has transcription services, and I get a chuckle all the time. I have one colleague, her name is Kirsten, but every time she leaves me a message, she says, "Hi, Julia, it's stomach," because that's what the transcription services thinks that Kirsten sounds like to them. But if you think about it, maybe it's a good time to talk about your borrower and say, okay, hi, it's Julia Koski. This is my phone number, and I need information from you. And you can go through all that detail, but at least they can at least clearly see in that transcription, need information from you, who you are, your phone number. The borrower is more apt to get back to you. So those are just some things that, as I've talked to lenders and I've talked to realtors, kind of that they wish that they'd had these conversations. So there's less back and forth, because we all know how wasteful of time that is. And then lastly, talking about emails. This by Contact Monkey, and I vacillate with this one, but subject lines with more than 3 words experience a drop in open rate, meaning drop that people don't open them by over 60%. So if you get a wordy subject line, people are like, oh God, I don't want to deal with that. And that could very well be true. So let's make sure that we're saying, you know what, action needed, loan information required, whatever it is, something that's going to catch their attention. So we just want to make sure that we see that. And you've worked with your borrower to say, okay, if you see something that says action item, open it, please. So again, we all are on the same team. Your lender, you, even your partners, your MI partners, your title partners, everyone's on the same team, because we want to get that borrower to the same place, which is the closing table, and have them be happy and satisfied with that transaction, and that they would want to recommend you to somebody else. So all of these things just simply take us to that period. So just finishing up with our Enact resources, you got lovely Tara Rock. She's your account manager. She's my counterpart in the Houston market, as well as a big chunk of Texas. And one thing I'm going to tell you guys, one thing I learned is that if you go from southern Minnesota, the very top bottom line of our state line, and go all the way to a town called, I think it's called Texahoma, which seems to be right on the border between Texas and Oklahoma, it still is a shorter distance than you take from Texahoma all the way to Brownsville. Your state is huge. I didn't realize how big it was. Anyway, Tara covers a lot of it, and she is more than happy to talk to you. She knows many of you, and she knows a bazillion of your lender partners. So I know she's listening here today. So Tara, you might be making some new friends on this. But so there you go. And then last piece before I turn it back over is, this is my legal disclaimer, just saying that this is training and I'm not offering you legal advice. So I thank you all very much for your time today. And if there's any questions, I'll be quiet and wait to listen to those.
I think we did have a couple of questions going back from earlier in the program. One was when you mentioned foreclosures, what about short sales?
Same thing.
Okay, the MI company's approval part. Okay. Did you have it? You want to expand? You can. If you
well, it's basically the property has to be sold. It has to be out of that process. So if it's a short sale, that process might start a little sooner, but it has to. It's all the same thing. It's going to be whatever the lender once it's out of their hands, and once they've taken it back, and then all the costs associated. But that property has to be sold.
Okay. And then someone had asked, Gina wanted to know, when is it that a client might need an FHA versus a conventional loan? Like, what decides the loan? What's typically the factors that you see?
Generally, the factors are, it tends to be affordability when you get down to situations where credit is a little bit more spotty. And I'm not saying it's a lack of credit. It tends to be that there's been credit issues in the past. Conventional loans start at a minimum credit score of 620, and that's what the MI guidelines are as well. And I believe FHA will go down to the, I think 580, maybe 560 range. I'm not 100% sure on that, please, because it's been a long time since I originated an FHA loan. But there's that. And then there's also the opportunities from a down payment perspective. There could be a little, there's 3% programs for conventional, but those might not work either. But FHA does have a good program in the sense that it's usually for folks with credit issues. And then there's opportunities for DTI to be a little bit higher as well on that. Okay. Whatever you do, here's the deal. And I don't sell mortgage insurance premium for FHA. I sell private mortgage insurance, and I work with Fannie Mae and Freddie Mac. There's nothing wrong with an FHA loan. they're perfectly fine, and they're great products. Just like VA is a wonderful product for veterans, but FHA works really well for a lot of customers. But
yep, great.
okay.
I agree.
Thank
Thank you so much, Julia. I really appreciate you taking the time. I know several folks have already hopped off for time's sake, but I appreciate those of you that have stayed on, and hopefully everyone, both you guys and the rest that were on the call, found some value in today's program. We do appreciate the time, Julia. It was a lot of great information, a way to different way to look at mortgage insurance. And as I mentioned, this is the 7th in a series of 10 monthly webinars. Next month, we're actually going to be talking more about local city and county programs. So should be a great session to learn more, about local things going on in the community, how you can help your clients better serve them, and hopefully put their, make it more easier for them to qualify for the opportunity to own a home. So that date for the program is Wednesday, September 15th. It will be 12 to 1:30, just like today. And you can register at har.com/webinars. And that's it. That's all. I hope to see you all next month. And thank you again, Julia, and have a great rest of the week.
Thank you, guys. I really appreciate your time. Take care.
Thank you. Bye-bye.